credit card debt is on the rise along with the interest rates that you have to pay on your credit card debt. Unlike a 30-year mortgage, which is fixed rate debt, your credit card debt is variable interest rate debt, which means as interest rates go up, your credit card balance becomes more expensive because the interest you have to pay on the credit card debt goes up. That means if you have credit card debt right now, it is more important than ever for you to take your extra cash and not use it to pay down your home faster, and not use it just to stack a whole bunch of cash, and not use it to invest your money. It's more important for you to use this money to pay down your credit card debt as fast as possible because your credit card debt is getting more expensive every single day. Let me show you the power of this. Let's assume that you have $6,500 when you turn 21 and you take the $6,500 and you invest this money. Now, the nice thing about this investment that you make is, let's assume that you can get an 18% return on your money every single year. And let's also assume that you never invest another penny again. So you take $6,500, you put it into this investment, you get 18% a year, and you do this until you retire. And now when you turn 66, so 45 years later, guess what? Your $6,500 investment is going to grow to not $1 million, not $5 million, not $10 million, but $11 million. By now, you're probably ready to type something like, Jaspreet, where in the world am I supposed to get a guaranteed 18% return on my money? Now sure, maybe you can't get that 18% return on your money, but do you know who is? Amex, Visa, MasterCard. These companies are charging you 18% or more every single year, and you have to pay this on your credit card balance, and this interest rate is about to go up even more, and you can see the power of compounding this money. $6,500 is the average household credit card debt in America right now. So if you just keep paying the balance, guess what? You are the one that's making Amex, Visa, MasterCard rich while it's keeping you broke. This is the money that I want you to compound for yourself. That way you can make yourself rich instead of making, well, everybody else around you rich. Now, I understand that you can use credit cards the right way. I love using credit cards because of the benefits and perks that I can get, but if you have credit card debt, it is not worth any. It's not worth any of the rewards, the perks, the cash back, any of that, because now you're the one that's making the credit card company rich. So if you have credit card debt, especially if you have $5,000 or more of credit card debt, what I want to do today is go over 5 things that you need to do right now that we can pay down this credit card balance ASAP. The first thing that you got to do is you have to stop spending money on your credit card. Okay, if you have credit card debt now, you want to take these credit cards, either cut them up, put them away, don't look at them, and just start spending money with cash. Use a debit card, use cash. That way you can't even risk putting more money on your credit card balance, because now you just got to get rid of that credit card. You can tell yourself that you can handle your credit card as much as you want, but as long as you have the credit card balance on your account, you need to take your credit cards and put it away. That way you can't accidentally spend that money on your credit card, because right now, when you have this type of credit card debt, it is skinning you alive financially. You got to get rid of this credit card debt, and the very first thing you need to do is get rid of the credit cards. That way you can't accidentally put another dollar on these credit cards, because you need to pay them off ASAP. The second thing that you got to do is you got to organize your credit card debts, because if you have more than one credit card balance, you need to know which one you should be paying off first, because some credit cards are going to have higher interest rates, some of them are going to have different balances than others, so you need to organize this. Take a piece of paper, write down how much balance you have on each credit card and what the interest rate is. If you have 2 different credit card balances and one of them is in a 0% APR period and the second one is charging you 18% a year, you got to pay down the one that's charging you 18% a year right now, and then once you pay that down, that's when you pay down the 0% APR credit card. If you have a bunch of different credit card debts, then you can decide if you want to go down the snowball or avalanche method. The snowball method means that now you're going to pay down the credit card balance with the smallest dollar amount first. So if you have a credit card balance with $500 and then $1,000 and then $2,000, you're going to ignore the interest rates and you're going to pay down the one with the smallest balance first. The only exception for this, I would say, is if you have a 0% APR balance, hold off on that one, pay off the ones that are actually charging you interest right now. The second, which is the debt avalanche method, is if you have a bunch of different credit cards, find the one that has the highest APR first, the highest interest rates first, and pay that one off first. So in this one, you're going to ignore the dollar amount. You're only going to look at the interest rates, find the one with the highest interest rate, pay that off, then go to the second one, then the third one, because in this debt avalanche method, you're gonna pay off the one that is costing you the most money first. I don't really care which method you pick as long as you're paying down your credit card. The debt avalanche method will save you more money, but if it's easier for you to stick with the debt snowball method because now you're paying down the ones with the smallest balance and you feel excited and you feel happy because you're getting the wins, it doesn't matter as long as you're paying it down. Now, depending on your credit score and depending on how much different credit card debt that you have, you might want to consider moving your balances over to a 0% APR card. What this allows you to do is typically you'll get like 6 to 12 months of a 0% APR period, which gives you a little bit of a cushion to start paying down this debt aggressively without paying any interest. But you have to keep in mind that after this period is over, you're going to have a very high APR rate. So depending on how aggressive you're going to be, you might be able to use this 12-month period as an opportunity to pay down this debt aggressively. But if you don't pay it off, well, now you're going to be the one paying the price because now you're going to have to go back to paying even higher interest rates. Third, you got to prioritize what's important to you. You will always find a way to do, buy, or achieve whatever it is that you want to do. I really learned this back when I used to guest teach in Detroit public schools. So every week I used to go there and talk to the kids in high school about money and entrepreneurship and motivation and leadership and all that type of stuff. And I remember when I was talking to the kids, I was asking them how they can start investing their money with just a couple $100. And I remember the kids saying, where am I supposed to get this couple $100? And so I started to talk to them. And a lot of these kids worked jobs. And I saw that some of them were wearing nice shoes, a lot of nice Jordans. And I asked him, how much did he pay for his Jordans? He told me he paid $500 for his shoes. I said, where did you get the money for your shoes? He told me about the extra hours he put in at work. He told me about the sacrifices he made. And he told me all the things that he had to do to get his shoes. And I asked him, you wanted to get those shoes, so you got the shoes, right? He said, yeah. I said, well, if you really wanted to invest and you needed a few $100s to start, you would find a way too, right? And then he kind of understood what I was trying to say. But if you really want to do something, you will find a way. If it's not that important to you, you're not going to find a way. You're going to want to go out to eat at Benihana's every single week. You're going to want to go to Disney World. You're going to want to get your spouse something nice. So you got to prioritize what's important for you. You're going to have to make sacrifices and not buy some of the things that you want. That way you have more money to, well, pay down your credit card debt, because this is holding you back from achieving so many things that you want to do financially. And that also means you got to start prioritizing where you're going to be putting your money. When you make that decision to become wealthy, is going to be like a switch, and you decide that you want to become wealthy, and all of a sudden you're going to want to do a whole bunch of things. That way you have less liabilities and you can have more assets. You're going to want to invest your money into places that are going to make you more wealthy. So you might say, oh, I want to pay down my home. That way I don't have to pay this 4% mortgage anymore. Or maybe you say, I want to start investing my money. I want to start investing my money in the stock market or real estate. So let me just put invest. And in this case, you might be getting an average 7 to 10% return a year. This is the average return in stocks and real estate. Or maybe you say you want to invest your money in crypto. Sure, maybe you can see 7 to 10, maybe 10, 15. It just depends on where it is that you're investing your money. You see more risk, you could see more upside, you could also see more downside. But what you end up doing when you're throwing your money here or here, which are good places to be putting your money, is you're missing the opportunity to pay down your credit card, which is charging you 15 to 25% a year. This is a much better investment than paying down your house. It's a much better investment than investing your money right now, because right now, this is going to give you a guaranteed 15 to 25% return on your money, because that's interest that you will no longer have to pay to your credit card company. We already went over what type of profits are possible when you get an 18% return on your money. Well, you're giving that 18% return to your credit card company when you carry credit card balances. If you have credit card debt, you should not be worried about investing your money. You should not be worried about paying down your house, and you should not be worried about going on vacation. Right now, the only thing you should be worried about is how fast you can pay down this credit card debt. Now, I know this isn't the most fun thing to do or the most exciting thing to do, and people are going to think you're weird when you turn down trips and when you turn down nights out, but you got to prioritize what's important to you in your life. If you want to be financially free, you want to be wealthy, you have to prioritize paying down your credit card debt. This is a mental thing. That means you got to prioritize where you're going to be putting your extra money and where you're going to be putting your extra focus. The fourth thing you got to do is you got to live smaller. So now you got it. You want to pay down your credit card debt. You've organized your credit card debt. You know it's important to you for you to pay down your credit card debt. But how do you actually pay it down faster? Well, the fastest way to pay down your credit card debt is to have more dollars every single month to pay towards your credit card debt. And the easiest or most simplest way to get access to more dollars right now is by having less expenses, because now you have money coming in and you just want to have less money going out towards your expenses, so you have more money left over that you can use to pay down your credit card debt. Now you don't got to do this forever. Once you pay down this credit card debt, now you have this extra money that you can use for your investments, your savings, and for your fun. But right now we got to pay down this credit card debt, and the way that you can start living smaller is one, by downsizing. Well, if you have a big home or a big apartment, maybe you downsize for a couple of years. That way you can save some extra money on your rent or your mortgage. If you don't like me now, then you're definitely not gonna like me after this, because another way that you can downsize and save a whole bunch of money is by selling your car. If you're paying $300, $400, $500, $600 a month in your car payment, and now you gotta pay the high insurance after that, and now you gotta put in premium gas in your car after that, you are spending so much extra money on your car when you could be using this money to pay down your credit card debt. So what I want you to do is take that car, sell it, and now go buy a used but good working condition car with cash. That way you don't have a monthly payment anymore. Now when you don't have this monthly payment, you can take that $500 that you were putting towards your car and use that $500 to pay down your debt every single month even faster. Then you gotta stop buying so many things. If you're not already doing this, start tracking your income and your expenses. This will immediately change the way that you spend your money without actually making any drastic changes in your life. All you have to do, either you get a piece of paper or you open up an Excel sheet or a Google sheet, and what I want you to do is on one column, write how much money you made. And then on the other column, I want you to write your expenses, and I want you to be detailed here. So every month you're gonna do this. So at the end of the month or the beginning of the month, you're gonna write down every single penny that you spent and where you spent it. Write down how much money you spent at food on restaurants. Write down how much money you spent at groceries, how much money you spent going out and entertainment and movies. Write down how much money you spent on donations and how much money you spent on gifts. Once you do this, you're gonna get a much better picture of where your money is going. And as soon as you see where your money is going, you are going to immediately, this doesn't even require any sort of financial education, I guarantee it, you're going to immediately start changing the way that you spend your money, because you're gonna see where your money is going and you're gonna say, holy guacamole, I spent how much money at Chipotle? After you do that, I want you to start working on your subscriptions. So if you have the massage membership, that car wash membership, and the 4 or 5 different streaming service subscriptions, start thinking about what you really need and what you can let go of. Remember, right now it's all about priorities. That Netflix might not cost you that much. I don't know how much Netflix is. I don't watch Netflix, but let's just say it's $15 a month. Might not seem like a lot of money, but if you're spending 2 hours every night watching Netflix, it's really not the money that's eating you. It's the time that you're wasting watching TV that you could be using to maybe earn more money or do something better with your time. That way you can use your resources to pay down your credit card debt faster. So you want to start really getting rid of these subscriptions, that we have less money going out and more money in your pocket. That way you can use this money to pay down your credit card debt, and more brain power to find more ways to pay down that debt. And finally, when it comes to your subscriptions, I want you to use this as an opportunity to start negotiating some of your bills. So most of your utility bills, your cable bills, your phone bills, your internet bills, a lot of these service providers will be willing to lower your bill if you just ask. Now, the key here is when you call up the service department and you ask them about lowering your bill because your bills have been going up, you have to be nice, okay? Because these customer service reps are getting yelled at by angry people all day and night long. So you want to be nice to them and ask them about why they raised your bill. Ask them if there's anything that you can do, because you've been shopping around and you see that some of their competitors are offering much better rates. So now you go there and you talk to them, see what they say, and that's where you want to push back and say, oh, really? Is there anything better that you can do? No matter what number they come back with, you want to always ask that question after they see if they can do anything better. That's when you're now going to propose a number. You don't want to go out there and just pitch a number right off the bat. You want them to see how much lower they're willing to go. After they go lower, then you want them to negotiate against themselves. And once they negotiate against themselves, that's when you want to present your number. Now, when you present your number, they're probably going to say no. And if they say no and you've been nice, ask them if you can speak to a manager or somebody else, because the manager or the supervisor has the ability to do a little bit more negotiating room on your bill. So ask them if they can do that, and now all of a sudden you have the same services but less money going out. And the fifth thing that can accelerate you paying down your credit card debt is earning more money. So now you understand that you prioritize your credit card debt, you know that you're living below your means, you're no longer using your credit card, and you're creating a margin that way you have extra money to pay down your credit card debt. The next thing that you can do to have more dollars to pay down your debt is just to earn more money. The way that you work to earn more money is going to depend on you. Maybe you work harder at your job, you get a raise, you get a promotion, you work more overtime 49 hours, you get more cash, that way you have more money to pay down your debt. If that's not feasible for you, then maybe you work to create a side hustle or you start your own business. That way now you have your income, but now you're working to create even more income. That way you have more cash, but you have to remember, prioritize. What are you gonna do with this extra cash? You're not gonna use it to go out and buy a new Beamer. You gotta use this cash to pay down your debt. Every extra dollar that you make right now needs to be used to pay down your credit card debt. So when you get that $5,000 bonus, don't use $3,000 of that to go out and finance a nice new vacation. Use that money to pay down the credit card debt faster, all of it. I know, this sucks. You worked so hard to get this bonus, you worked so hard to make some extra money, but this is where it's so important for you to prioritize what's important. You're gonna take this money, pay down your credit card debt, and once that credit card debt is gone, now you don't gotta worry about it, because now you're gonna be smart enough to not do it again. And now when you earn more money, you're gonna be able to use this money to make yourself wealthier and to make your life better. That we don't have to worry about making the credit card company rich. The reason why I save earning more money for last is because you have to understand how to use your money and build the right mindset first. Because if you just start earning more money right in the get-go, but now you have more money, but you don't know how to use it. This is why you first need to build the right mindset. You need to start living below your means. You need to start prioritizing what's important. And once you build that system, this is where earning more money is going to have the biggest bang for its buck, because now when you earn more money, you know what you're going to do with it. You're going to use this money to pay down your credit card debt, and once your credit card debt is done, now you're free. And now you can move on to the more fun and exciting things like investing your money. If you're a money nerd trying to figure out the best way to use your credit card, chances are you're gonna go down one of two different rabbit holes. Either you're gonna go down the Dave Ramsey rabbit hole, where you're gonna never ever touch a credit card, or you're gonna go down the credit card hacking rabbit hole, where you're gonna try to figure out how you can maximize every single spending purchase that you can. I'm not a credit card hacker. I don't have 45 different credit cards trying to maximize my rewards to the max. It's too little upside for too much time. And I'm also definitely not a Dave Ramsey when it comes to credit cards. Now, Dave Ramsey is a very smart person. He has a very good program and he's helped a lot of people get out of debt. But I tried the Dave Ramsey method when it comes to credit cards. I've read a lot of Dave Ramsey's books, and they've taught me a lot about money. And they also scared the crap out of me when it came to credit card debt. And so for me to avoid all this credit card debt altogether, I just avoided credit cards. For years, I was the guy with the fat wallet because my wallet had a whole bunch of cash in there because I didn't want to use a credit card. I didn't even like using a debit card. I only wanted to make transactions with cash because I didn't want to spend more than I needed to, and I didn't want to go into credit card debt. But now I only use a credit card because my credit card company pays me for my smart spending through my credit card. And you might notice that I have a little bit of a tan right now. Is because I was just in Jamaica for a week and my credit card paid for my trip. No, I didn't swipe with my credit card. My credit card rewards paid for my entire 1 week trip to Jamaica. I had about $10,000 worth of rewards sitting in my credit card account for doing nothing except just using my credit card to make my regular transactions. So I used that money to pay for my flight and my stay and my entire trip. And I'll show you what I did in this video and how you can use a credit card the right way, because there is a right way and a wrong way to use credit cards. I prefer to only buy things with a credit card because of 4 reasons. My credit card gives me cash back. It gives me pseudo insurance. It's not real insurance, but pseudo insurance. It gives me financial protection, and I get a whole bunch of perks for using my credit card. I'm going to be going over a whole bunch of credit cards that I use. I'm not being sponsored by any of these companies. I'm not being paid by any of these companies. I'm just trying to tell you the things that I use and how I use my credit card the right way, so I don't have any sort of financial incentive to push any credit card over the other. That way you can make a fair decision if you want to get another credit card or not. When it comes to most of my general spending, I'm looking for a card that's going to give me cash back. So here are the cards that I use. This is a business card. It is a Capital One Spark card. This is the card that I use for most of my business transactions. And then I have my Chase Freedom Unlimited Visa card. This is a personal credit card that I use for most of my personal transactions. Both of these I use for cash back. Now again, I'm not sponsored by any of the credit cards that I'm talking about in this video. None of these companies are paying me. I'm just telling you what I use. So I spend probably a few $100,000 a year or so on this credit card for my business. Now this credit card has a $150 annual fee, and I get 2% cash back on every dollar that I spend. So if I spend $1, I get 2 cents back. If I spend $100,000, I get $2,000 back. And if I spend $300,000, I get $6,000 back. So every year I have all of my regular business transactions, and I use this card to do that. And every time I do that, I get 2% cash back. So as I spend money, I get 2% cash back, and this is money that I can use for essentially whatever I want. Now, for my personal cards, my personal transactions, I use this Chase Freedom Unlimited card. This one has a $0 annual fee. This is for anybody, and I get 1.5% cash back on everything. There's another version of this where it's a rotating cash back system where you get different amounts of cash back on different items, like you get different cash back on your food, different cash back on your gas and all that. I don't like playing that game. Right? I'm not a travel hacker. I am not a credit card hacker. It's too much work for me. I just want something that's going to give me cash back on everything. That way I don't have to think and spend so much brain power trying to figure out which credit card that I want to use because it's not worth that effort for me. So this gives me 1.5 cash back on everything, and it has a $0 annual fee. So all of my personal general transactions, I'll show you why I say general when I talk about the others. I use this one because I get 1.5 cash back on everything. So every time I spend money, if I'm going out and buying groceries, if I'm going out and buying other stuff for my personal life, then I use this and I get 1.5 cash back. So the way I paid for my Jamaica trip was through this card right here, my business card. I had about $10,000 or so in cash back that was just saved from me making regular business transactions. And so I used that cash to then pay for the Jamaica trip. Now, while I know I said that I don't try to hack this cashback game, there's only a couple exceptions to that because for one, I do a lot of my shopping on Amazon. So I have the Amazon Prime card, which gives me 5% cash back on all of my Amazon purchases. I spend a lot of money on Amazon, so I got this card because, well, it gives me 5% cash back on all of that. And then I also have this credit card for my business. It is called the Carrot card. This is kind of a more exclusive card made only for influencers. It's an invite-only card at the moment. And this card is very interesting. It's for businesses, more particularly influencers. It gives you 3% cash back on only 3 categories. So I get this on travel, I get it on food, and I get it on camera equipment. So for all of that, I get 3% cash back. It has a $0 annual fee. And they have this interesting feature where every once in a while, they do a 5% cash back promotion. So if I'm going to go book a business trip or have to buy some camera equipment, I'll usually just wait until that 5% promo goes around, and then I'll buy it with 5% cash back with this Carrot card. The cool thing about this credit card is it is the thickest and heaviest credit card that I've felt, and if I drop it somewhere, I don't know if you can hear it, but it sounds like you just dropped glass on the table or a piece of metal. Second, when it comes to insurance or pseudo insurance, because I don't think legally I'm allowed to say insurance, credit cards are cool because they give you a whole bunch of protections separate from this protection factor that I'm talking about, just if you make a transaction with the right credit card. So let me give you an example. I have this Amex Platinum card. I use this card for my traveling, and when I went to New York a little while ago, this was back in 2021, I flew on Delta to get to New York, and when I landed, they lost my luggage. My suitcase did not arrive, and now I didn't have anything, so I had to buy some supplies because now I didn't have a suitcase. Amex covered it. They covered the cost of all the supplies that I had to buy because I didn't have a suitcase, and then because I didn't have a suitcase, they were going to cover the cost of my lost suitcase, but then a few weeks later, Delta found my suitcase, and then I was able to get that back, but at least the money that I had to spend to now buy a whole bunch of replacement items, I was able to get that covered through Amex. Now, one thing that you have to understand through this card particularly is this one is pretty expensive. This one right here, this Amex Platinum card has almost a $700 annual fee. It's $695 a year. It went up. It used to be $550 a year. You can get a cheaper, lower tier Amex card if you want the pseudo insurance. The reason why I have this card is because of this. I'll talk about the perks that I get with this card. But one of the biggest advantages of credit cards, and probably one of the most underutilized thing about credit cards, are these insurances that you get, the pseudo insurances that you get, because you get so much protection through your credit card if you just know what it offers. A buddy of mine is a DJ, and he used this card, the Chase Freedom card, to buy some of his speakers, and this Chase Freedom card extends your manufacturer's warranty by another year. So he bought some speakers and they stopped working after the manufacturer warranty expired, but this card extended that warranty for another year. So then he called up Chase because they have a free manufacturer's warranty that's included with this card, which extends the warranty that you have for whatever you buy, and then they reimbursed him for the cost of the speaker, or they got him a new one. I forgot what they exactly did, but they gave him his money just because he made the transaction with this credit card. The third benefit with credit cards is the protection that you can get, and this is arguably the most valuable thing that you get with credit cards, because this protection is something that you don't really get anywhere else. The reason why credit cards are so valuable, because I'm going to draw this out right here. This, let me say this is you. Draw a nice mustache for you. This is you. This is your bank account, and this is whatever it is that you're buying. When you go and buy something with cash, money automatically leaves your bank account and you buy it because you use your cash to buy whatever it is that you want to buy. When you use a debit card, it's the same thing. It's automatically taken out of your account. But when you use a credit card, now you have a third-party intermediary. You have this card right here, and then this card will buy you whatever it is that you want, and then after the transaction is settled and after you make a payment, that's when the money leaves your bank account. So you have this intermediary there, your credit card, which protects you, which means if some sort of fraud happens, if somebody takes your credit card and they swipe it, well, it's not money that's leaving your bank, it's money that's leaving your credit card company's account, and then your credit card company is insuring you for that. Or if you buy something and you don't get what you promised, well, if you bought it with cash, now you have to fight to get your money back. But if you do it with a credit card, well, now it's the credit card's problem because you tell the credit card company, hey, I bought something, but I didn't get what I was promised. So you can create a credit card dispute. Your credit card will give you your money back. And now it's the credit card's issue that they have to fight. I was in Boca Raton, Florida not too long ago. It was my first time in Boca. It's a beautiful place if you've never been there. Beautiful part of Florida. So I was in Boca Raton and I booked this 1 week health treatment. It was like $7,000. And I went there for 15 minutes, or maybe 30 minutes, and it was nothing like what I was promised. It was not what I was looking for, so I said that I didn't want to do it. I left before I even finished the first half of the first day, and I asked to see if I could get my money back, and they said that they wouldn't do that. So I called up Visa, because I bought it through this credit card right here, and I told them the issue. They said, don't worry, Mr. Singh, we'll take care of it. By the end of the day, that $7,000 was already refunded back to my account, and then Chase dealt with the company, and now it was the credit card company's problem. It was no longer my problem. I got my money back, I didn't have anything to deal with, and it was all the credit card company's issue because now I wasn't playing with my money, I was paying with my credit card company's money, and so they dealt with the issue, not me. I got my money back and I was able to live my life because the credit card gave me protection. Pretty much every single credit card is going to offer some sort of protection. Some are going to be better than others, some are going to give you more time to file disputes, some are going to give you more dispute opportunities, some are going to protect you better than others, but in general, most credit cards are going to offer this type of protection. And then we have number 4, the perks. This is the fun stuff that you can get with credit cards, especially if you know how to use your credit card the right way. Now, every credit card is going to have different types of perks that you can use and take advantage of, but for me, mainly I use the perks when it comes to travel because I travel quite a bit. This is where I have 2 different credit cards. I have 2 different Amex cards. I have the Amex Platinum, which I talked about, and then I have this Amex Delta Gold card. So let me start with this one because this one's a little bit simpler. I use this card because I get 2 things. First, when I have to check in a bag, this covers my check-in bag for free. This card is just under $100 a year, and I fly on Delta pretty often. So if I go and check in a bag at Delta, it's gonna cost me $30 one way and then $30 back. It costs me $60 for a checked-in bag per trip, so if I go on 2 trips, that's $120, versus this card costs me less than $100 a year, and this covers my checked-in bags. The second advantage of this card is it also helps get me more upgrades on Delta, because as we all know, flights are expensive, and if you wanna upgrade to Delta Comfort, if you wanna upgrade to first class, especially on domestic flights, sometimes it's not going to make sense to pay $2,000 for a 3-hour flight. So instead of paying for that, sometimes this card will just give you the upgrade for free because you have the right card. Now this is where it also kind of becomes a game, because the way it works with this card is the more money you spend on this card, the more likely you are to get that upgrade. But I don't always want to spend my money on this card because I'd rather get the cash back and all the other things that I talked about. So for me, I don't spend a lot of money on this card because I just want to get that free checked-in bag, and then if I get an upgrade, I get it. So it's a game where you have to decide what's more important to you. But the main thing here for me is I get my money back with this card because I use this card to pay for all of my checked-in bags. And then the second card that I use for perks is the Amex Platinum card, the one that costs almost $700 a year. So the first question that everyone asks about this card is, do you get your money's worth when it comes to this? And to be honest, the answer is probably no, because I'm not really trying to see if I can squeeze every penny out of here. What I'm getting out of here is just a lot of value. So what you're buying with this card is really a bunch of comfort and some added luxury, more than really trying to squeeze every single penny out. So anytime I fly, it gives me a place to relax, it gives me a place to hang out, which is really cool. And then it gives me free upgrades on car rentals, it gives me free upgrades at certain hotels like Hilton's and Marriott's. Anytime I go there, or most of the times I go there, I get a free upgrade on my room just because I have this card. So I like that luxury that I get with it. And it also gives you things like $100 to spend a year at Saks Fifth Avenue, and it also covers the cost of your TSA pre-check and your clear entry. So it gives you a whole bunch of free perks if you are traveling a lot. The more you travel, the more benefits you get. But again, are you going to get $700 worth of value? Maybe, maybe not. But at the end of the day, the value of this card is really the luxury and the comfort that you can get. Now, one of the most common questions that I get when it comes to credit cards is, isn't the credit card interest rate high that you have to pay when you carry a credit card balance? Yes, it's very expensive. That's why I never, ever, ever carry a balance. If you pay your credit card balance off in full, on time or early, you will never have to pay a penny in interest. I have never paid a penny in interest on any of my credit cards because I always pay off all of my credit card balance in full before it's due. Now, if you cannot control your spending, or if you don't know if you'll be able to pay off your entire balance in full every single month, then what I want you to do is you look at all these rewards and I want you to just delete them from your mind, because these perks, these rewards, this insurance, this cash back is not worth the price that you're gonna pay in interest. If you're gonna be using a credit card, I need you to make a YouTube promise with me. Okay, we're gonna do one of these. I've never done this before, but you need to promise with me, I see you through the screen, that you're never gonna ever buy something that you normally wouldn't if you weren't using a credit card. You're gonna make sure that you pay off your entire balance in full every single month, and you're gonna make sure that you don't spend money that you don't have. If you cannot control your spending, you gotta be honest with yourself. If you cannot control your spending, don't use a credit card. What I want you to do right now is just use cash. Use your cash to buy things, because that will help build that discipline when it comes to spending, because that will show you what you can afford. If you only have cash in your wallet, you'll never be able to spend more money than what you have because you only have $100 in your wallet. So start with that. Start by just using cash. Once you're comfortable spending money with cash, once you know how to spend money, once you have that discipline mentally, that's when you can start using a debit card. Now you can practice using a piece of plastic, and with a debit card, you won't be able to spend more than what you have, because again, this debit card is only going to be able to spend how much money you have in your bank. So you're kind of progressing your way up. After you're comfortable using a debit card, then you can advance your way to a prepaid credit card. A prepaid credit card works kind of like a credit card, where you get some of the benefits of a credit card, but in order for you to use this credit card, you have to pre-fund it. So maybe you put $500 a month into your credit card, and now you're going to use this credit card to make your transactions, but you can only spend how much money you fund it with. So you're kind of advancing now past the debit card. That way you understand how credit cards work. And once you advance past that, then you can consider getting a credit card. But again, I want to reiterate this, because these perks, bonuses, promotions that you get with credit cards are not worth the interest that you would have to pay. So you want to make sure that you're not the person that's paying the interest. You want to make sure that you're the person that's getting paid by the credit card company. In the financial services space, credit cards work kind of like life insurance in the sense that they're both very heavily misunderstood. If you do not know how to use these things the right way, it is going to end up skinning you alive. But if you know how to use them, you can use them to your advantage. And this is the point where everybody starts to ask, what can I do now to increase my credit score? What can I do to get that 800 perfect credit score? That way you can get a better interest rate. Now, I've talked about how to use your money smartly. I don't want you to use your credit score that we can go out and finance a whole bunch of liabilities. I don't want you to go out and start financing things that aren't paying you. But if you're gonna go out and buy a home, having a good credit score can help you. And having a good credit score can also help you get approved when it comes to renting a home. So it helps to have a good credit score. You just wanna make sure that you don't use it the wrong way just to finance a whole bunch of things that aren't paying you. But if you wanna have a good credit score, there's a few things that you can do. 90% of a credit score depends on 5 categories: your payment history, your credit usage, the age of your credit accounts, the credit mix, and your new credit inquiries. Out of those 5, the most important 2 are your payment history and your credit usage. You can't really do much about the age of your credit accounts, because if you're 25 years old, chances are you haven't had a credit card for 10 years unless your parents set you up when you were a teenager. And when it comes to your credit mix, you don't want to just go out and start taking loans just so you have a different mix of credit cards. It's better for you to not have these loans on your liabilities, so you don't want to just go out and get loans for a better credit score, because now you're losing in this credit game. And then when it comes to new credit inquiries, that's a small piece of your credit score. And again, you just don't want to be applying for new credit cards every single week. But the most important are these: your payment history and your credit usage. First, when it comes to your payment history, you have to make sure that you pay your bills on time, especially when it comes to things like your credit card, because if you miss one payment, it is going to hurt your credit score, and it's going to hurt you, because now you're going to have to pay interest on whatever it is that you bought, and credit card interest rates are not cheap. So if you're going to use a credit card, remember that YouTube promise that you made, because because now you have to make sure that you pay all of your credit card bills on time. So set up an automatic payment. Set up an automatic payment and make sure it happens every single month, where now you're never late on your credit cards. Second, when it comes to your credit usage, all this means is how much of your total credit line are you actually utilizing. So if you have a $10,000 credit limit, are you spending $10,000 every single month, or are you having a smaller utilization? Are you using less of that? They say that the optimal amount is 30% or so or less of a utilization. So if you have a $10,000 credit limit, you want to be spending around $3,000. Now, I'm not saying to go out and spend more money. That way you can hit 30% or go out and spend more money so you utilize more credit. I'm saying that if you have a big enough credit amount, that's how much money you should be putting on your credit if you want to have the optimal credit utilization. You do not want to go out and try to spend more money just to have a more optimal credit utilization. You just want to understand that you don't want to be using all of your credit limit every single month, because that can put a ding on your credit score. So if you are getting close to your credit limit every single month, because that's what your monthly expenses are, then you might want to consider increasing your credit limit. And of course, another thing that you can do, which is not listed here, is pay down your debt. Because if you have outstanding credit card debt, if you have outstanding bills that you have not paid, pay that off. So spend less money, earn some more money, do whatever it is you got to do to pay off that debt, because not only is it hurting your credit score, but even more importantly is hurting your finances, because this extra interest that you're paying every single month is making somebody else rich and is keeping you broke, because what you want to be doing is making yourself rich. That way now you can keep using your cash to build your wealth instead of just giving it to everybody else. If you have $1,000 or more of credit card debt, don't go and jump into a 0% APR credit card. Don't put money into the stock market, and do not refinance your home to pay down your credit card until you understand this. Credit card debt is one of the most expensive kinds of debts out there, which is why if you don't treat your credit card debt properly, it can skin you alive financially. And this is why you have so many industries and so many people trying to sell you services to consolidate or relieve you of your credit card debt, because they know how expensive it is. My goal in this video is not to sell you any service, but to teach you different ways and things that you can do to pay down your credit card debt, because there's a lot of things that you can do yourself to pay down your credit card debt, so you can pay less money to your credit card company so you have more money to actually build your wealth. And there are 5 things that I'm going to be going over that you want to do in this order. So let me start by talking about number 1. Get some extra money. Look, there's no point for me to sugarcoat anything in this video. Paying down your credit card debt takes time, it takes effort, and it will be painful for a little while, because you're going to have to make financial sacrifices. You need more money to pay down the credit card debt faster, period. How do you get that extra money? Well, there's 2 things you can do. Either you can spend less money, or you can work to earn more money. You need to create a margin where now there's a margin between how much money you bring in and how much money goes out, between how much money you make and how much money you spend. The bigger the margin, the more cash that you have to actually pay down your credit card debt. So now, how do you make this margin? Number 1 is by spending less money, and number 2 is by earning more money. When it comes to spending less money, this is now what can you cut back on? If you're eating at restaurants, if you're going on vacations, if you're still going out and shopping, you got to cut these things out. That way you have less money going out. It's not the funnest things to do, but spending less money is the most accessible way to have more money, because it means you just stop doing something, you stop buying things, you can stop going places, so you have less money going out. It's not fun. I mean, your friends are going to look at you like you lost your mind, your parents are going to think you were crazy, and your spouse is probably going to think you went a little nuts too, because now you're not spending money the way you used to. But if you really want to get out of this financial hole, you got to stop doing the things that got you into this mess in the first place. And for most people, that's spending way more than they're bringing in. That means now you got to cut the bleeding, and means you got to stop the spending. Once you can stop the spending, now we can start thinking, how do we grow the pie? Because the reality is there's always a limit to how much you can cut back on. But there's no limit to how much you can earn. Right? I mean, if you make $5,000 a month, there's a limit to how many expenses you can cut. But there's no limit to how much you can earn. I mean, you can take that from $5,000 a month to $7,000 a month to $8,000 a month, even $50,000 a month or $500,000 a month. But it requires you now to look for alternative ways to earn money, because if you just keep doing what you're doing, yeah, maybe you'll get your regular pay raises and start earning some more money. But if you really want to go from the $5,000 a month to the $50,000 a month, you're going to have to do something completely different. And you're going to have to start investing in your financial education of how do you actually earn more money. But you have to be smart here and not just start earning more money so you can spend more money, because that's going to put you right back to where you are in the first place. The biggest mistake that so many Americans make is that when they earn more money, they spend more money. That's why so many people are playing this rat race where they never actually build any wealth, because anytime they get a raise, they get a promotion, they get a bonus, you spend more. You get a bonus, you go on a vacation. You get a raise, you buy a new car. And this is where we got to cut back on the way that we spend our money and understand, why are you working to earn more money? Right now, you got to earn more money, that way you can pay down this credit card debt. How can you earn this more money? Well, there's a whole bunch of freelancing agencies on the internet where you can do things. Maybe you can do the accounting for a company. If you're good at graphic design, you can build designs for a company. Maybe you can be a virtual assistant for a company. There's a lot of different types of services for peoples with all different types of skills that you can sell these services to businesses who need that help. Now, you can work on your own pace, you can work on your own schedule, and you can set your own prices, but it's a way for you to start earning more money. Maybe you work additionally at your job. Maybe you work a second job. Maybe you create your own business idea and you start marketing this. That way you can start earning more money. You got to earn more money and spend less money so you have a bigger margin. That way you have more cash to pay down your credit card debt, which brings me to number 2. Now, use this margin smartly. Let me show you the easiest way for you to become a Deca millionaire. You take $110 a month. Then you take this money and you're going to invest it where you can get a minimum 20% annual return on your money. And if you do this for 40 years, you are going to have over $11 million in your account. Pretty simple, right? Well, I already know what you're thinking. Jaspreet, where in the world am I going to find an extra $110 a month? No, you're probably not thinking that, because when you see these types of numbers, you're not going to be struggling to figure out where you can find that extra $110 a month. You will find this money. The question is, where can you get a consistent 20% return on your money year after year after year? Well, do you know somebody who is doing that? Your credit card company. Your credit card company who's charging you 20, 21, 22, 25% a year in interest is the company that is making millions off of the dollars that you are spending. This is where you have to understand the importance and the severity of this credit card debt and not treat it lightly. This is where now, when you create the margin that we were talking about in step 1, where now you're spending less on what you're bringing in and you're working to make more money, you have a bigger margin. What are you going to do with this extra cash? And so many people in this instance will say, well, I also want to start investing. Should I put my money into the stock market? Should I use my money to go out and start investing in real estate? Should I go out and do something else? No. If you have credit card debt, the first thing you want to do before you think about investing your money into the stock market, before you think about buying ETFs, before you think about buying index funds, before you go out and start investing your money into real estate, is to pay this debt down ASAP, because your credit card debt is skinning you alive. The average historical return in the stock market and the real estate market is somewhere between 7 to 10% a year. This is what most investors are aiming for when they invest their money into the stock market or the real estate market. Does this guarantee you're going to get a 7 to 10% return? No. But when you pay down your debt, you're getting a guaranteed return. Because if you can pay down your debt 1 year early, that's a guaranteed 20% return. Maybe you'll get a 10% return in the stock market. Maybe you'll get a 20% return. Maybe a 50% return. But you can also lose 20% of your money too. This is where you have to understand that before you go out and start investing your money, you want to take this margin now, this extra cash that you have, and you need to use it to pay down this debt ASAP. And if you really want to accelerate this some more, that means downsizing on some of the things that you have. If you have a car, downsize it. Sell the BMW, get a Toyota. If you have a big home, if you have a big and expensive home, downsize to something that's more manageable. If you have a whole bunch of things in your basement or your house that's just collecting dust, sell it. Turn this excess stuff into cash, then take that cash and pay down that debt sooner, because every dollar you pay faster above the minimum payment, well, that's money that you no longer have to pay interest on. And the faster you can pay down this principal balance, the faster you can stop paying interest. And the faster you can stop paying interest, the faster your credit card debt will stop skinning you alive. And the faster your credit card debt stops skinning you alive, the faster you're going to be able to invest your money to actually grow it and build your wealth. Right now, the credit card companies are investing their money by lending it out to you, which is how they are getting rich. I want you to stop making them rich and then start making yourself rich. But before you start making yourself rich by this, you got to zero yourself out. The way you do that is by paying down your credit card debt. Number 3, once you have your internal financial system in place, This is where now you can consider moving your credit card debt to a 0% APR credit card or something like that. The way that these 0% APR cards work is they will give you 0% APR for 6 months, 12 months, maybe 18 months, depending on what the card or the promotion is. And now you can move over your credit card balance where you're paying 20% interest to 0% interest, and you're going to have a little period where you don't have to pay any interest. Now, the way that they make money is because they're betting that you're not going to pay off your credit card debt in time, and then as soon as that 0% APR period is over, they're going to slap you with even higher credit card fees and higher interest payments. So now, the reason why I say you don't want to move your money blindly to one of these 0% APR cards is because most people do that without any sort of financial system. They just move it because they think, oh, no payments for a little while. That sounds like fun. Now you can buy and spend more money, and then your credit card balance goes up even higher. Now you have even higher interest payments and a higher principal balance. That's why the first thing you want to do is get your financial system in order, know how to spend less money, know how to earn more money. That way you have that margin. Take this margin, don't go out and invest it. Use that money to pay down your credit card debt even more aggressively. Then now you can start considering your other options. One of them can be a 0% interest credit card, but understand that you're going to have this little period, this little grace period where you need to pay down that debt aggressively. You want to hammer that credit card debt down. You don't want to go out and start spending money on this credit card to build up that balance. This is your time to build down that debt, to tear it down, not build it down. Tear down that credit card debt because you have this period of no interest. So during this 12 months, 6 months, 18 months, you need to be aggressively paying every penny possible to pay down that debt, because if you don't pay it off in time, well, you're going to be hit with a whole new wave of interest payments, maybe even higher than what you were paying before. But if you know how to use your money, it can create a huge buffer, because now you got this year or so to pay down your debt interest free. The fourth thing that you have to understand has to do with refinancing your home if you own a home and using this cash to pay down your credit card debt. In theory, it sounds good because you can get a mortgage for say 7% and your credit card debt might be costing you 20%. So if you can refinance say another $10,000 out of your home, take this $10,000, pay down your credit card debt. Now instead of paying 20% in interest, you only have to pay 7% on your mortgage, and you just add that new credit card debt to the back of your mortgage payment. Sounds good because I have a lower interest payment, but it comes with a lot of risks. The first risk is that your credit card debt is an unsecured loan, meaning it's not backed by anything, meaning the credit card company only has your promise that you will pay it. If you don't pay it, they can send you letters, they can sue you, but they can't force you to sell your home. Versus with your mortgage, if you don't make a mortgage payment, your bank can force you to sell your home. They can force you through a foreclosure and they can take your home away from you. From your credit card debt, they can't do that. The second reason why this is so important to understand has to also do with bankruptcies. America is one of the few places in the world that allows you to bankrupt out of debts if you need to. Now, whether it's good or bad is a completely different discussion, but if you were bankrupting your credit card debt, you can make the credit card debt go away because it's an unsecured debt. It's not backed by anything. Versus many states will not allow you to just bankrupt your way away from a mortgage. Now, there are some exemptions to this and other states have different rules, but you can't just bankrupt your way away from a mortgage the way you can bankrupt your way out of credit card debt. And number 5 is understanding the debt reduction methods out there. This is more of a last resort. Ideally, you're going to be working to make more and spend less, that way you have extra cash to pay down your debt aggressively. But there are some kind of last resort options that can help you reduce the amount of debt out there. Number 1 is a debt settlement. Now, there are companies that do this for you, but they're going to charge you a fee. You can try to do this yourself as well, where essentially you work with the credit card companies and say, look, I owe $10,000 worth of credit card debt. There's no way I'm ever going to be able to pay back this $10,000 ever. How about instead of me paying back $10,000, we settle at $6,000? Now, there are companies that will help you do this again, but there are YouTube videos and a bunch of other information out there that can allow you to do it yourself, where now you're just going to be negotiating with your debt holders to reduce the amount of debts that you have. Option number 2 is a debt consolidation. This is where now if you have multiple different types of debts, that you're going to roll all these debts together into one debt with ideally a lower interest rate. Now, this doesn't reduce the amount of debt out there. The goal is just to reduce the amount of interest that you're paying, and this can also have its own fees associated with it. There are companies out there that do this. You could try to do it yourself as well. Again, there's a lot of resources online that will teach you how to do this, but again, it's not going to make the debt go away. Its goal is just to reduce it into one monthly payment. The best way to pay it down is to work to earn more and spend less. These are two options that can help make it a little bit easier. And then you have option number 3, which if you really have no other option, you can consider bankrupting your finances, bankrupting your way out of the credit card debt. Now, I know there's a lot of negative connotation around filing for bankruptcy, but the reality is our legal code allows for it. Now, whether it's good or bad is a completely different discussion. The goal here now for you is how do you protect your finances and take care of your finances and build the best financial future for yourself. If you made a lot of financial mistakes and you realize that and now you want to completely change your life, well, you could consider a bankruptcy. There's a lot of attorneys out there that will specialize in that. There are cons with bankruptcies, like you have to pay money, it's going to hurt your credit score, and it can be very emotionally tolling, but if you have no other option, that can be a last resort as a way for you to get away from that credit card debt. Now again, ideally the best case scenario is you're going to work to earn more and spend less so you can hammer down the credit card debt, but this is a way that if you have no other option, that this is also there for you too. If you own a home and you're trying to figure out what do I do with my extra cash? Should I save it? Should I put my money in the market? Or should I use my extra cash to pay down the mortgage on my home? Well, in this video, what I'm going to do is I'm going to break down what is the best investment for you depending on what your goals are, and financially what is the best thing for you to do if you should pay down your home, because there are some benefits to paying down your home and there are also some cons to paying down your home. So let's dive right into it. The first thing that you want to understand is kind of where in the home ownership cycle that you're in, because when you go and get a mortgage, let's assume that you get a 30-year fixed rate mortgage, your mortgages are front loaded, meaning that your payments that you're making in the early part of your mortgage are going primarily into the bank's pockets in terms of interest and their profits, and you have a teeny tiny little bit going to pay off your actual principal, meaning the home balance on your loan. And so what happens is for the first half of your mortgage, the first almost 15 years or so, you have more of your monthly payment going into your bank's pockets for interest than actual paying down your principal. Let me actually dive a little bit deeper and show you. I'm on banker.com. You can try this out for yourself, but I put a loan amount of $500,000 at a 30-year loan term at a 6% interest rate, and I'm going to assume that the loan starts on January 2023. That way it's easy for calculations. And if you just look at this chart, what you'll see is this dark blue line shows the amount of money that you're paying in principal, and the light blue line is the interest. And if you start the mortgage in 2023, it isn't until, where is this? October of 2036 until more of your payment is going towards your principal balance rather than your interest paid. Now, it goes a little bit more interesting if you go into this next tab, which is the schedule. And what you'll see here is that in 2023, in the 12 months of you paying your mortgage of about $3,000 a month, only $5,600 is going to pay down your principal balance, while $27,361 is going directly into your bank's pocket of interest, meaning you paid over $32,000 over the course of 2023, and only $5,600 went to actually pay down the balance of your home. Now, while this information might not be a determining factor of whether or not you should pay down your home or not, it might give you a little bit of a fire under your butt to realize that, oh my God, a lot of my money is going directly into my banker's pocket, and if I do pay down my home faster, well, then I can help build my equity in my home without just making my banker so rich. Because if you pay down your home faster, you have less interest going into your banker's pocket. But now the question is, what happens now if I invest my money instead? Well, yeah, maybe I'm still putting my money in my banker's pocket, but if I can put more money into my pocket by investing my money myself, then it's worth it. Because if I have to put $10,000 into my banker's pocket in terms of interest, but I can make $20,000 from my investing, well, I can just take 10 grand from my investing profits, give it to the bank, and still have $10,000 left for myself, so you end up a winner. So the question is now, can you get a better return on your money by not investing your money into paying down your mortgage and investing your money in yourself? Now, the calculation here is relatively straightforward. If the interest rate from your home is less than the interest rate from your investment, then it makes sense for you to invest your money, get a better return, and then use your profits to pay down your home mortgage, because now you can do it at a profit, because now, yeah, you're paying interest to your banker, but you're making more money from investments. The problem here is that here investing your money also comes with the R word, which is risk. Because while the average stock market return is 10% a year historically, and the average real estate return is also right around 10% a year, that doesn't mean that the stock market and the real estate market are guaranteed to go up by 10% every single year. It's an average, meaning some years the markets go down. Some years they go up higher than 10% a year, and if you look at it over the long term, you're making 10% a year. But if you don't have that sort of investing experience, you might not see that same 10% return. Maybe you get a lower return. And this is where that risk factors in, because you can also lose your money by investing your money. So if you're losing money by investing your money, but you could have gotten a guaranteed return by paying off your mortgage, well, then you're losing. Because when you pay off your home, it is a guaranteed return. If you're paying 5% a year on your mortgage, or 6% a year, or 4%, it doesn't really matter what you're paying, and you pay off your mortgage 1 year early, well, that's a guaranteed return on your money, versus here, there's no guarantee. However, here, you could potentially get higher returns, but it's not guaranteed. Now, the question is, how do you find the right answer for you? And this is going to depend now more on your financial goals and on your risk tolerance. Because if your financial goals are, I just want to be free, I don't want to have to worry about money, I don't want to have to stress about money, I want to live small, I just want to be able to live my life and never have to think about money again, well, you don't have to take on a whole bunch of risk then. Because if you can pay off your home quicker, well, now the biggest expense that you probably have is going to be paid off, and now you only have to worry about your property taxes, and you don't have to worry about paying a mortgage ever again. If on the other side you say, I don't really care about risk, I want to live bigger, I want to live large, I want to live lavish, I want to have all the nice things, I want to have all the nice stuff, well, then you got to be willing to take on more risk. And if you want to take on more risk, that means maybe it's better for you to invest this difference, invest the extra money instead of paying down your mortgage, because paying down your mortgage might give you a 3 to 4 to 5, maybe 6% return on your money if you pay it off early. But if you invest your money, there's a lot more potential return there. And now you can try to get better returns, try to earn more money. That way, now you have more money to pay down this. Now, of course, is it riskier? Yes, but now you have to understand that the risk needs to match your goals. Because if you say, I want to live large, I want to have all these nice things, but I don't want to take on any risk, well, now you're speaking out of both sides of your mouth. You want to have the nice stuff, but you're not willing to put in the work or take the risk to do that. And so you have to understand kind of where it is in your life that you want to be and what your goals are, because that's going to dictate what you do next. Now, one thing that I do want to point out here is if you have other sorts of debt, things like credit card debt, things like your home equity lines of credit, these are higher interest rate debts, then it would be more beneficial for you to pay that off instead of just paying off your mortgage, because when you're paying off your 16% interest rate credit card, well, that's a guaranteed 16% return on your money. Here, when you invest your money in stocks or real estate, the average return is 10% a year. But when you're paying 16% to your credit card company, that is a guaranteed 16% return for your credit card company, but you're the one that's paying that. So it's more beneficial for you to pay off these high interest rate debts instead of investing your money and instead of paying off your home, because your home mortgage, I'm assuming now, is under 16% a year. If you have a mortgage that's costing you more than 16%, we have a problem, and we got to talk about something else here. But if you have a normal mortgage rate, this is where you have to understand what are the bigger debts, and you want to be paying off that credit card debt as fast as possible. Now, the counter argument could potentially be, but Jaspreet, we're talking about the home that I live in. If I don't pay off my home, well, then I could risk potentially losing my home if I don't make my home payments. But my credit card, I could just declare bankruptcy on. Now, if you don't have the money to make the minimum payments on your home or your credit card, this is where you need to get an advisor ASAP. That way you can figure out what you need to do, whether it's an attorney or an accountant, because now you want to make sure that you can take care of your family and your finances, and you need to know what your options are ASAP, because yeah, you don't want to lose your home, and you also don't want to get defaulted on by a credit card company. So that is a different situation. But if we're talking about the general now, if you have extra cash, do you put that money towards your credit card or towards your home? Put that money towards your credit card, pay the high interest rate off, and now we can talk about home versus an investment. And the answer here, yeah, is the return that you can get, but secondly is the lifestyle that you want to live. Now, if you do want to make that decision that you want to pay off your home early because you don't want to ever have to stress about payments again, because nobody likes making payments. I hate making payments. If you don't like the idea of making payments and you want to pay off your home early, great. Now, what you have to understand next is that when you make your extra payment to your bank, to your lender, you want to make sure that the extra money that you're putting towards your mortgage is being applied to your principal balance and it's not being used to pay off your next month or your next payment for your loan balance, because these two things are going to give you two completely different results. Because if you use your extra money, if you have an extra $5,000, for example, and you use this money to pay off your next month's balance or your next balances, well, now what's happening is you're just prepaying your next month's bill, and then the next payment you make is just going to be going towards the following month, which means that this $5,000 that you're paying is going to be going partially into the bank's pocket and partially to pay down the principal balance. And instead, what you want to have happen is all $5,000 that you're investing back into paying down your home is going towards paying down your principal balance, and none of it going into the bank's pocket. So if you're going to pay down your home early and you're sending in some extra money to the bank, make sure you do it as a separate payment, and make sure it is clear that this money that you're giving to the bank, to the lender, is going to pay down the principal balance entirely, and none of it is going to interest. So if you're paying it online, there should be an option there. If you're sending in a check, make sure you send it in as a separate check. Talk to the lender, talk to them, make a note, let them know that you want all of this money going directly towards your principal balance, and it's not going to interest. I can't emphasize this enough because it will make a big difference in how much money you pay overall, and you want to bring down the principal balance as fast as possible, because as soon as the principal balance starts to go down, the amount of interest that you'll be paying will also go down, so it'll save you more money over the long run as long as you are paying down your principal balance faster. Now, if your question here is, okay, I kind of like the idea of both, maybe you put some money towards paying down your home faster, but you also want to invest your money. This is where now the more financially educated you are, the better returns that you can get, and this is where now you can build real wealth, because now you're building equity, you're building investments, you're building assets that can pay you, and now you own these assets which are now paying for your lifestyle. But this is where now you have to understand the different ways that you can invest your money. And I'm just going to start by talking about me, because it might help you understand the different options that you have, because there are 5 places that I invest my money. I invest my money into my own business and startups. So I have a company called Market Briefs, and I invest my capital, my cash, into this company because I want to build this into a bigger financial media company. Second, I invest my money into real estate. I talked about in previous videos how I invest my money into real estate for cash flow, where now I buy houses, single family homes, I buy apartment complexes, not for the purpose for me to live in myself, but for me to rent out to other people. That way now it's providing me consistent cash flow. I also invest my money into stocks. So now I'm investing my money into individual companies. I'm investing my money into ETFs, which are funds, which will now I buy for appreciation, because I believe in the economy. I believe in the long-term health. I believe in the long-term growth of the economy, and I want a piece of that. The stock market allows me to do that. Fourth, I invest my money into cryptocurrency. I look at cryptocurrency less as a meme opportunity just to try to flip things and make a quick profit. I look at it as the future of money, the future of property, and the future of technology. I think there's a lot of value in the blockchain and the things that it can do, and I look at it as a software. So I invest in it for that purpose. And I also invest in physical gold, which is the 5th place I invest my money. And when I invest in physical gold, I'm not really trying to get a return on my money per se. I'm investing in physical gold as an alternative to saving money, because the physical gold provides a better store of value than my cash does, because cash can be printed, you can create more inflation, which dilutes the value of cash, versus gold has to be mined. It takes time, effort, and labor to mine a physical ounce of gold. And so I know that this gold isn't producing more value, but for me, it's a better hedge against inflation, and it's kind of like insurance against the worst case scenario. So those are the different ways that I invest my money. And now this is where you can start to understand there are many different ways for you to invest. It's not just putting your money into ETFs. It's not just putting your money into the market. There are a lot of different ways for you to invest, and each different investment opportunity can provide different returns depending on which phase of the market cycle that you're in. Now, I'm not a trader, I'm a long-term investor, and I understand that some of these asset classes will do better in certain economic cycles than others. But I also understand that it took me a long time to understand how to invest my money. It took me a lot of mistakes. It took me a lot of years. It took me a lot of books. It took me a lot of education. I took a lot of courses. And this is where, if you're just getting started, you want to start investing in your own education. This could be reading books, taking classes, but then also the experience, because you cannot just ignore this experience. That experience is the best teacher. Making mistakes is one of the best things that you can do, because you're going to learn very quickly when you lose your own money. And when you lose your own money, you're going to want to learn how you never do that again. So it's going to put some fire on you to learn how to invest your money better. But this is where now understanding the different ways that you can invest your money and start educating yourself, whether it's through books, YouTube videos, podcasts, classes, or actual education by doing it yourself. It's about putting in the education and putting in the reps by learning. That way now, as you become a better investor, it's much easier for you to get better returns because now you're better educated and you can find the opportunities a whole lot easier. If you're finally starting to get paid and now your boss comes to you and says that, hey, you can invest your money in a 401k or a 403 or a 457, and you have no idea what these things mean and you don't know how to invest your money and you want to start investing for the first time, you are in the right place. Making your first investment can be scary, and it's a whole new world that most of us are never exposed to. You hear all these terms like the IRA and then the 401k, and then some of you might be hearing about a 403b or a 457b, and now you don't know where to start. Do you take one of these tax-deferred retirement accounts, or do you open up your own investment account, or do you start investing in mutual funds or index funds or ETFs? And so in this video, I want to start breaking all of this down. That way you know how you can start investing for the first time. That way you can make smart decisions with your money. That way you can build up this new nest egg that will make you wealthy. The inspiration for this video came because a good friend of mine who is now a brand new doctor got his first job and is finally starting to get paid, and his boss offered him a few different investment options, a 403b and a 457b, and he had no idea what these things were. He did not know what an IRA was, and so he called me and asked me, how do I make my first investment? This is the first time I'm starting to make money, so what do I do with my money? How do I now build wealth? And unfortunately, regardless of how much schooling you go through, most of us are never taught a thing about how to invest our money to become wealthy. That way we can actually be financially free. So here's what I want to do. I want to start by going over the different tax-deferred retirement accounts. These are things like the 401k, the IRA, the 403b, the 457b. I want to go over what they are, how they work, how to invest in them, and then I want to give you my thoughts on them. That way you can get my opinion. After that, I want to go over ways that you can invest your money yourself. This would be things like mutual funds, ETFs, stocks, and then I want to go over alternative investment options. That way you can think outside of the box and know the different ways that you can invest your money. That way you can build your wealth. So let me start here with the tax-deferred retirement accounts. But before we do that, I need you to do me a quick favor and smash the thumbs up button below. These tax-deferred retirement accounts are the most popular ways for people to invest your money because a lot of these are completely automated. When you invest in your 401k or your 403b or your 457, a lot of times you're going to be working directly with your employer, and now your employer is going to help you set up this account, and anytime you get paid, some of your money is directly going to go into your retirement account, and this money is going to sit there until you hit close to retirement age, and then you will be able to pull your money out. The reason why people like these tax-deferred accounts is because they are tax-deferred. You have the option to not pay any taxes on the money that you invest today, or you can pay your taxes today, and then you don't have to pay taxes when you pull your money out in the future. So within all four of these accounts, you have a traditional version, and then you have a Roth version. The traditional version, so a traditional 401k, traditional IRA, traditional 403b, traditional 457b, all these things mean that you do not pay any taxes today. You invest your money today, and then this money gets to grow tax-free. So every time you make a profit, you don't have to pay taxes on it. And then when you start pulling this money out when you're a whole lot older, that's when you pay taxes, when you pull the money out. With the Roth, it's the opposite. With the Roth option, Roth 401k, IRA, 403b, 457b, you pay taxes on your money today, and then this money goes into your account. I'm going to go over why the tax difference matters and which option is better for you in just a second, but let's start by going over what the difference between these different retirement accounts are. So your 401k, your 403b, and your 457b are all essentially the same thing. It's just who can offer that plan. Your 401k is typically reserved just for your private companies, your private employers. You do see some government companies or some big nonprofits offer 401ks, but most of the time it's only going to be a private employer. Your 403bs are for government employees and for your nonprofits. And then your 457 plan is for people like teachers and first responders and city officials. The biggest difference between these three plans is going to be with your 457b, because what the 457b says is if you pull your money out of your retirement account before you are 59 and a half years old, you don't have to face a penalty. But if you pull your money out with a 401k or a 403b before that 59 and a half years old, then you're going to be subject to a 10% penalty on the money that you pull out. So this has a little different rule where you can pull your money out and you don't got to worry about that fee, but you got that fee here. The next major difference isn't on the legal side, it's more on the practical side, because what you're going to see happen with a lot of companies is a lot of companies are going to give you some sort of 401k match. If you invest $100 into 401k, they might give you $30 or $100. They might match $1 for $1, just depending on who your corporation is. but a lot of times you're not going to see those types of matches in the 403b and the 457b just because of the way that they work. So a lot of times you're not going to see the same match options here, but you will see that here, which makes the 401k more attractive to a lot of people. So the way that these accounts work is you can open up a 401k, 403 or 457b. Your employer will tell you how. Once you open an account, you will be able to automatically invest some of your paycheck into these accounts. Again, you could do the traditional way or the Roth way. I still got to talk about that, but you can invest your money into these accounts, and once your money is in these accounts, you can kind of decide how you want your money invested. Now, you're not going to be able to invest your money completely by yourself. Typically, what you're going to do is you're going to pick which kind of funds that you want to invest your money in. So you're going to be limited typically as to who and where you can invest your money, because when you open these accounts, your employer is working with some sort of institution on how you can invest your money. So you'll typically get some sort of brochure, some sort of investment pamphlet that will go over your different investment options, and then you'll be able to see where you want to invest your money. And then you'll be able to pick, do you want to be more aggressive with your investments? Do you want to be more conservative with your investments? And based off of that, your money will be invested into these funds based off of what your investment criteria are. The thing that I need you to please understand are fees, because what so many people do not understand about these retirement accounts are the fees that they're paying. Now, at this point, you might be thinking, wait, my 401k is charging me a fee? Yes, they are. When you invest your money into these funds charge a fee to manage your money. And some funds are going to charge you a whole lot more than other funds. So what you need to do is you need to look at something called the expense ratio. This expense ratio is going to tell you what the fees are for the funds that you're invested in. Some of these fees are going to be upwards of 1% or even 2% of your assets a year. That means if you invest $100, they're going to take $1 or $2, depending on what the fee is, right off the top every single year, whether or not you make money. But there are other accounts that will charge you a fraction of that, and they will get you similar returns. So if you have a retirement account right now, do me a favor, open up your brokerage account and see what your expense ratio is. That way you can see what it's costing you every single year. Generally, now this is not something that you need to always follow, but generally, if it's costing you more than 0.75%, that would be considered a high fee. So just something to keep in mind. An IRA works essentially the same as these other three, except now you're not doing it through your employer. You're managing your IRA on your own, because an IRA stands for an individual retirement account. So this means you can go to your bank, you can go to any financial institution, you can open up an IRA, and now you are the one in charge. You're not doing it through your employer. You can create an IRA wherever you want, and then when you create your own IRA, you have the option now to, again, invest the money the way that you want. If you go to a specific brokerage or if you go to a specific bank, they're going to give you their own investment options, or you can create something called a self-directed IRA, where now you have the ability to invest your money yourself. But essentially, the thing that you need to understand about an IRA is that this is a way for you to invest your money on your own and get those tax benefits that people look for with these accounts. Each one of these retirement plans have a contribution limit, meaning there's a maximum amount of money that you're able to invest into these accounts in 1 year. So for example, the 401k, the 403b, and the 457b have a maximum contribution limit of $20,500 in 2022, and the IRA has a maximum contribution limit of $6,000 in 2022. The whole idea behind this is the IRS and the government doesn't want you to take 100% of your income and put it into these accounts, because then you could just not pay any money in taxes on your income today, and the IRS wouldn't like that because they need their tax money. Which brings me to the topic of understanding the difference between a traditional or a Roth investment. So again, a traditional investment means that you're going to pay taxes on the money that you invest, not today, but when you pull it out. And a Roth investment means you're going to pay taxes today, and then you're not going to pay taxes when you pull your money out. The reason why people like this traditional investment is because, well, you don't have to pay any taxes today. You invest your money into your account, you let your money grow, and then when it comes time for you to retire, you're going to pull your money out, and that's when you're going to pay taxes. The reason people like that is because people say, okay, well, when I pull my money out, I'm going to be old, I'm not going to be working a job, so even if tax rates go up, it's not as big of a deal because, well, I'm going to have no income. And if I have no income, then my tax rates are going to be lower. So when I pull my money out, I'm going to have a lower tax rate, so I can pay less taxes because now my money can grow essentially tax-free. Then I pull my money out, and then I'll pay taxes when I have no income at a lower tax rate. People who follow the Roth model will say, well, I don't know what's going to go on with tax rates. I think that because the United States national debt is skyrocketing and I don't see our national government spending slowing down, I think the government is going to want to raise taxes. And if they raise taxes, it will be more beneficial for me to pay my taxes today than when I pull my money out. Plus, you might also be thinking, hey, I'm investing a lot of my money. I'm trying to build more income. I'm trying to build assets. So my goal is when I turn 60 or 65 is not to have a little bit of income. My goal is to have a whole bunch of income when I'm older. So it's more beneficial for me to pay my taxes today because I want to really be wealthy and I want to create a whole bunch of income streams. So you just got to figure out what your goal is and what your financial plan is. If you plan on not doing anything and not having any other income when you're 60 and not having any assets or investments that are going to pay you, then sure, a traditional is going to make more sense. But if you plan on buying additional assets every single year and you plan on building and stacking your additional streams of income, that way by the time it comes to your retirement, you're going to be having a whole bunch of income, well then this is going to make a whole lot more sense. This is what a lot of the minority mindset people do because we're working to build assets. We're working to create new income streams. That way you can make a whole lot of money, not a little bit of money as you get older. Now that you understand how these tax-deferred retirement accounts work, let me tell you my opinions on them. Because I don't have any of these tax-deferred retirement accounts. I invest my money on my own. I don't use any of these tax-deferred retirement accounts because for me, I can get better tax breaks and get a better use of my money today instead of using one of these accounts. Now let me make sure that I'm very clear with this because what I do isn't for everybody. For the average person, hey, these are fine. But I am very involved with my investments. I like to be active with my investments. I have different strategies and different goals with my investments which give me different tax breaks. And because of that, I don't have any use for these investments. But if you are not into investing your money, if you're not really into being that involved with your money, you're just looking for passive ways to invest your money and you don't want to create whole new streams of income, then hey, this is a great way for you to get some tax benefits and invest your money on the side. I don't like the idea of my money being tied up in an investment where I can't pull my money out if I wanted to. And if I did, I'm going to be penalized. I don't like the idea of my money being tied up in an investment where I don't have a say of how my money is going to be invested. And I don't like the idea of my money being invested into a fund where I can't control the fees or where now I'm subject to higher fees than if I just invested that money into a fund outside of one of these retirement accounts. My investment goals are very different than most people's investment goals because I'm not working for a traditional retirement. I'm investing my money very differently, which is why I don't need these and I don't need to create a fund where I'll be able to access it when I'm 60 years old and then have this nest egg that I can live off of. That's not my investment goal. But again, for the average person, if you're just starting off, this is a great way for you to start, but this should not be your sole investment plan and it should not be your sole retirement plan, which brings me to number 2, investing your money yourself. You do not have to invest your money into a tax-deferred retirement account or to a 401k to invest your money. There are ways for you to invest your money outside of these accounts, and if your employer is not giving you a match or if they're not giving you free money to invest into one of these retirement accounts, then you might get some extra benefits by investing your money yourself because now your money is not tied up anywhere. Now, you're not going to get the same tax benefits here than you would if you used a 401k or an IRA or a 403b or a 457b, but now you have the full control over your investments and you can access your money anytime you want. There are 4 very accessible ways for you to invest your money into the stock market without going through your traditional tax-deferred retirement account. You can invest in a mutual fund, you can invest in an index fund, you can invest in an ETF, and you can invest in stocks. All of these things allow you to invest in stocks just in different ways. So the stock market is a place where you can go to invest your money into your favorite companies, and it is a way for you to bet on the future of our economy. So if you think the economy is going to go up, well now you have a way to invest and get a share of that upside by investing your money into the stock market. If you go out and you buy 1 share of the Amazon company, well now you become one of the part owners of Amazon. The reason why this can be intimidating or this can be hard is because a lot of people don't want to spend the time, effort, or research trying to figure out which company to invest in, or they don't want to be an investor themselves, they just want it to be passive. They want to invest their money and get some of the upside. This is why things like the 401k and the IRA have become so popular because they are a very passive and easy way for someone to just invest their money and let their investments do their thing. But the thing that you have to understand is that your 401k and your IRA were never intended. They were never intended to be your sole retirement plan. Even the founder of the 401k has come out and said that the 401k has gone awry because everybody believes that the 401k is all they need in order to be financially successful when they retire. But that's not the case. You're going to have to invest more money outside of your 401k, which means you need to invest your money yourself. But that doesn't mean that you have to be doing stock picks. It doesn't mean you have to actively manage your investments every single day if that's not what you want to do. There are other ways for you to invest your money outside of your tax-deferred accounts, which are also passive. passive. Mutual funds, index funds, and ETFs all work very similarly in that they are a basket of stocks. When you invest in any one of these three, what you're doing is you're investing into a fund that's giving you exposure to a whole bunch of stocks. So instead of you trying to invest in 100 different companies, you can invest in a fund that's invested in 100 different companies, and now you're getting exposure to these 100 different companies without having to actually invest in every single one. The whole idea here is you are limiting your risk because now you are not trying to figure out which companies to invest in. You're putting your money into a fund, and these funds invest in a whole bunch of companies. It might be 30 companies, it might be 500 companies. So this fund invests in a whole bunch of companies, and you're getting exposure to all these companies to lower your risk. That way now, if one of the companies in your fund goes bankrupt, you're okay because now you still have a whole bunch of other companies which are going to help balance out that loss. Each one of these funds work a little bit differently. A mutual fund is known as an actively managed fund, which means that now this fund has a manager, a money manager, who is getting paid to now find the best company to invest in. So this person is now going to be buying and selling stocks, they're going to be researching companies, and they're going to be trying to get you the best returns possible. That's what a mutual fund is. An index fund and an ETF are passive investments. That means instead of having an expensive money manager, you have a computer, and this computer has an algorithm, and this algorithm is going to say, okay, we want to invest in, let's just say, the biggest 500 companies on the stock market. And now if one of the companies in your list goes lower or they go bankrupt, this computer is going to kick that company out and put a new company in. So it's passively managed, which means that here and here, your fees are a whole lot less than here because now you have to pay for an expensive money manager. So this is one of the reasons why people really like ETFs and index funds, because your fees are a whole lot less, and most money managers, most mutual funds cannot outperform the market year after year after year, especially after you factor in the fees. So here with this and this, you can just get exposure to the market. When the market goes up, you get the same returns. When the market goes down, you will also see your fund go down. There are ways for you to invest in the general stock market. There are ETFs and index funds that give you exposure to the general stock market, and your fees are a whole lot less. So here, you're paying less fees and you can get the general returns of the stock market, versus here, you're trying to beat the stock market, but you're gonna pay higher fees, and most money managers cannot beat the stock market over the long run. ETFs and index funds work very similarly, except the way that they trade, because ETFs trade differently than index funds. ETFs trade just like stocks. You can buy and sell shares of an ETF just like any other stock. You can buy it in the morning, sell it in the evening if you wanted to. Don't recommend doing that, but you can. And you have no investment minimum to invest in an ETF. Sure, you just need the money to buy the share of an ETF, unless you're buying fractional shares of it, but you have no investment minimum. Versus an index fund, you're typically going to have some sort of investment minimum. It might be in $1,000, it might mean $10,000, depending on which index fund you're investing in, but you have an investment minimum and you can't trade it the way that you can in ETF. With an index fund, it's not trading all day long. It usually just makes one trade in the morning, and that's it. So if you want to sell your index fund, you would have to wait until the next day, as opposed to an ETF. You can trade it just like any other stock. In terms of your actual investment though, you're getting the same thing here and here. You're both getting your low cost to invest, and you get kind of the same investments. Like you have ETFs that give you exposure to the top 500 companies in the stock market, and you also have index funds that give you exposure to the top 500 companies in the stock market. So the whole idea with index funds is it's really made just for the long-term investor who is not interested in trading. It is just a very passive way for you to invest your money for the long term. With ETFs, same concept, except now you can trade in and out of it very easily. And then you have the ability to invest in individual stocks. So these are more of your long-term, your passive ways to invest your money in the stock market. If you don't want to be an active investor, if you don't want to research companies, if you don't want to keep up with all the financial news, hey, just invest your money in any of these three, and now you have an additional way to invest your money. You just keep putting money into these investments every week or every 2 weeks or every month. You're just going to keep investing in these things when the market is up and down. You're just going to keep putting money in there, and you're going to let your money grow and compound over time. So that's the strategy here. With stocks, it's very different. If you want to be more active with your investments, you have the ability to earn more money, because now you can try to find the best companies to invest in. Now, obviously, that has more risk, because you can invest your money into a company and then see it go bankrupt, and how you lose your whole investment. But you also have the ability to earn more money, because now you can invest in a company before it really just takes off. Because if you can research companies, you find a company that you believe is hot, and then it takes off after you buy it, well, now you get to share in all the upside because you are an owner in that company. The mistake that so many people make when they're investing in the stock market is, first they ask, okay, I want to invest my money in the stock market. What stock should I buy? Instead of trying to figure out, okay, what is my strategy? What is my goal? How do I want to invest? They just want to know what stock do I buy. And then what happens is they buy on emotion. They say, yeah, I want to be a long-term investor, because everybody knows that your long-term investors make the most money sustainably. You can make a lot of money in the short term as a trader, but traders also lose a lot of their money. I mean, something like 80% of traders end up losing money over a period of 12 months. But now you say, okay, I want to be a long-term investor because I know that's how I can make money. That's how Warren Buffett made all his money. I want to be a long-term investor. And then you find a hot stock to invest in. You put your money in there, and then 4 months go by and you see your stock in the red. You see your stock down. And now you start to panic. They have a bad earnings, they have a bad quarter, and now you start to get really worried. You don't know what's gonna go on with this company. You're losing money, and now you sell. You panic, and you just get out, and now you lost money. This is where you need to have a strategy. And again, why if you want to be investing in stocks, you have to understand what that entails, because now you need to be doing the research. The way you do that as an investor is you have to look at the fundamentals of a company. That means you need to understand the cash flows. You need to understand the profit and loss. You need to look at all the financials. Look at the numbers. Are they profitable? If so, how are they profitable? How much money are they making? Where are their expenses? Where are they investing? If they're not profitable, how do they plan to be profitable? So you want to look at the numbers, come up with a valuation. Then you also have to look at the non-numbers. You need to look at the company itself. Who are the executives? Are they innovating? What kind of products are they creating? Do they have a loyal fan base? How hard is it for another company to come in and compete? What is their real secret sauce? What makes them special? If you can come up with this and you can come up with a good valuation, then you can look at the actual trading price of a company, and then you can say, hey, I think this company is undervalued and it has a lot of upside. And so that will be an opportunity for you to invest. But if you look at the numbers and you say, you know, I think this company is too expensive. I don't want to invest. These are the type of questions you need to be asking yourself, and this is what every fundamental long-term investor is doing. They're looking at companies, they're trying to see what these companies are doing, and they want to value these companies based off of their own metrics, and based off of that, if the company is trading for a price that is lower than what they think their valuation is worth, then they're going to come in and buy. If the company is worth more than what they think it's worth, then they're not going to buy. This is what you need to be doing as an investor, and it takes time and it takes practice. This brings me to number 3, alternative investments, because there's more ways for you to invest your money outside of the stock market. Like, I love investing my money in real estate. I also have money in cryptocurrency. I also have money in commodities like physical gold, and I also invest in startups and other businesses. There are ways for you to invest your money outside of the stock market if you want to be more involved with your money, and these allow you to get paid in a variety of ways. Let me start by talking about real estate. When I invest in real estate, I don't just buy a property with the goal of trying to sell it for a huge profit. When I buy property, my goal is to get cash flow. So if I buy a property for, let's just say $150,000, I'm gonna buy this property not with the intention of selling it for $200,000. I'm buying it because now I know that this property is gonna rent out for $1,500 a month every month, and now what I've done is I've created a new passive stream of income. So now I own this asset, I own the real estate, somebody's gonna live there, a family's gonna use this property, they're gonna live there, they're gonna get the value out of this property, and in exchange, they're gonna pay my company, my real estate company, rent every single month. And now $1,500 is coming into my account every single month, and I don't really have to do any work. I have a property management company who I've hired to do all the day-to-day work, and they're the ones that when something goes wrong with the property, they call the property management company. So yeah, all the $1,500 isn't profit. Some of that money is going to the property management company. Some of the money is going to taxes. Some of the money is going to go to maintenance fees and management fees. And if you have a mortgage on the property, some of the money is going to go to debt. But if you do it right, it's also going to put some money in your pocket every single month passively. And now what you've done is you've created a new stream of income. Plus, as an attorney who's not your attorney, I can tell you that real estate also offers some of the best tax breaks that our tax code has to offer. So when you invest in real estate, not only can you get cash flow, but you can also get legal tax breaks. With cryptocurrency, it's very different. Cryptocurrency is a much more speculative and it's a much more risky and volatile investment in the sense that you can see cryptocurrency rise and fall very fast. But you have to understand, again, why are you investing? I like cryptocurrency because it's the people's movement of money. People are losing their trust in the Federal Reserve Bank, they're losing their trust in the Treasury Department, and so people are looking for alternative ways to store their money, to store their wealth, and one of the ways that they're doing that is with cryptocurrency, and you also have a lot of powerful technology behind cryptocurrency. Again, very risky, and if you don't know what you're doing and you just dump your money into it, then you might be very disappointed if you see cryptocurrency prices go down. Again, this is where education is so important, and if you want to learn more about cryptocurrency, I'll link an interview that I did with a cryptocurrency expert going over how cryptocurrency works and how you can invest in it, and I'll link that for you in the description. With gold is very different. I own physical gold, not a gold ETF, but actual physical gold, and I look at gold as real money. I don't look at gold as an investment. I don't care if gold prices go up or down. For me, gold is real money because it represents a store of value. It takes time, effort, and labor to mine an ounce of gold, so it really represents value as opposed to our dollars, which aren't backed by anything tangible. It's not backed by gold or silver or anything else. It's backed by a promise by the United States government that our dollars have value. And because of that, the value of our dollars can be manipulated, they can be diluted, and so I own physical gold as a protection against that. But again, I don't look at gold as an investment that's going to make me rich. I look at gold as an asset, as a money that I keep as a store of value. And then I invest in businesses because I'm an entrepreneur and I love working with other entrepreneurs. Obviously, we have here Minority Mindset, a company, but I also invest in other startups. So I like working with other startup founders, and the way that I work with these companies is not just by giving them cash, but I like actually working with the companies. I like working with the founders to help advise them, to help them grow. That way we can take this company and help solve more problems, which will help the company grow even bigger, because an entrepreneur's job is to solve a problem. If you can solve a problem for a lot of people, well, now this company will be able to grow bigger. So this, again, is highly risky. You can lose all of your money by investing in startups, but you also have the ability to earn more money, because now if a company that you invested in grows big and then they go public or they get acquired, well, now you can get a big payday. But again, highly risky, and you have to be involved to understand what you're doing, and you have to be willing to understand and take that risk. Now, some of these can be very hard to do. Like investing in real estate can be difficult because you need access to a lot of capital, and investing in businesses can be hard because if you want to go out and invest in a startup, you might need a lot of money or have the right connects to do that, and investing in gold can be hard because you don't know where to do that. So these things can be difficult, but technology has made it easier for the people that are willing to learn. For example, with real estate, you don't have to invest in physical real estate to get exposure and the upside of real estate. You have platforms out there which allow you to invest in crowd-funded real estate. That way now, you don't have to buy an entire property. You don't have to be the person that deals with tenants. You don't have to be the person that gets the call when the toilet is broken. You're just investing into a fund which gives you exposure to that type of real estate. With businesses, before, if you wanted to invest in a startup, you had to go and find the companies and go pitch to the startup or have the startup pitch to you. Instead, then you had to find the right companies. They'd have to come to you and make a deal to invest in them. Now, thanks to crowdfunding, you can invest in startups with as little as like $100, and now you can go and invest in some of these companies. Again, highly risky, but now you can get exposure to these companies at an early stage. That way, if they go big, you got in early because now you were able to do that thanks to technology. The key for any of this to work is that when you get paid now, you have to allocate a portion of your money to your investments. If you're just getting started, that might mean the 401k or IRA or 403b or 457b. But as you start to be more involved and as you start to see the upsides of investing and as you want to be more active in your investments, you might say, hey, I want to see what other investments there are, or how can I be more involved in my investments, or how can I invest my money myself? This is where you have to understand, okay, I'm getting paid, you take a portion of your paycheck, this is money that I have to invest. Now you can see all the different places that you can invest your money, because different investments will have different upsides, different goals. Real estate is cash flow. Gold is preservation of your wealth. Cryptocurrency, you're trying to see more upside. In business, you're trying to see more upside as well by investing in these early stage companies. So every investment has a different goal, and when you have that goal, now you just need to understand where you want to invest. And this is where your financial education comes in, but it all starts with understanding how to take that initial money and knowing where to put it. That way you can start to see that upside and start to use your money as a tool to build your wealth. If you like what you saw so far, then you're gonna love this. Financial planning is one of those things that we're all expected to know how to do, even though most of us are never taught how. Well, maybe if you had financially savvy parents, they told you to save a little bit of money, and maybe if you're up for it, invest a little bit of money too. The problem is, if you don't give your money a plan, then your money will leave. Money, where'd you go? Come out, wherever you are. The majority of people have a 3-part financial plan that looks something like this. They make money, and then they spend money, and then they wonder where all their money went. Okay, money, you can come back now, but it doesn't have to be like that. Look, if you can order Chipotle with extra guac and get it delivered to your doorstep without ever leaving your sofa, then you can come up with a budget that will help you build your wealth. You just want to make sure that your budget sets you up for building wealth instead of just getting by, because there's a big difference between these two types of budgeting. The first thing you need to do is figure out where all your money is going. Money, where? Oh, there you are. Why do you keep hiding from me? This is the part that nobody likes doing, because you're gonna have to talk with yourself about your spending habits. What did I tell you about paying $700 for scarves? It's almost like when you were in high school and then your teacher would pass back your test results and you would see that, oh my God, you were so close to an A, but you had made 15 careless mistakes. Maybe that was just me, but you have to do the same thing now with your money, except you have to be the one that grades yourself. We're gonna do this the old school way, so I want you to clean off your kitchen counter and bust out your bank statements, your payroll statements, and your credit card statements. Now, write down how much money you made last month, and then write down where all of your money went. So write all of your expenses, and write how much money you saved and how much money you invested. Wow. Before you can make a plan on what to do with your money, you need to know where all your money is going. So guac is really extra, huh? Hopefully looking at your money is going to be the inspiration that you need to go out and make a better plan with your money, because that's exactly what we're going to do now. An average financial plan does two things. It tells you how much money you can spend, and it tells you how much money you should save. A good financial plan does three things. It tells you how much money you can spend, it tells you how much money you need to invest, and it tells you how much money you need to save. A great financial plan automates your good financial plan. You got to come up with the best ratio of spending, investing, and saving for you, or you can follow our 75-15-10 or 50-30-20 plans. If you are older and you have financial responsibilities, you can follow our 75-15-10 plan, which says that for every dollar that you earn, you can spend a maximum of 75 cents, you should be investing a minimum of 15 cents, and you should be saving a minimum of 10 cents. If you are younger and you don't have financial responsibilities, this is your time to double down and build your wealth, so you can follow our 50-30-20 plan, which says that for every dollar that you earn, you can spend a maximum of 50 cents, you should be investing a minimum of 30 cents, and you should be saving a minimum of 20 cents. The easiest way to force yourself to stick with your plan is to automate it and create 2 or 3 different bank accounts. One bank account is going to be your checking account. This is the money that you can spend. One bank account is your savings account. This is your money that you're saving for emergencies. And one bank account could be for your investment money. I say that one bank account could be for your investment money because it depends on your financial goals. Some of you might just want to be very passive investors, where every month a percentage of your paycheck is automatically invested for you and you don't want to be hands-on with your money. If that's you, then you don't need a separate bank account for your investment money, because this money can automatically be withdrawn from your checking account and just go straight to your investment account. If you want to be more active with your investments and you want to pick and choose what your investments are, then it helps to have a third bank account where you take the cash that you want to invest and put it into this bank account. That way you can easily see how much cash you have waiting to be invested. The reason it helps to have a different bank account for your spending money and your saving money and your investment money is because you don't want to accidentally spend your investment money on a new TV. Your spending account has all the money that you're allowed to spend. So this is the money you can spend on your rent, your mortgage, your groceries, charity, and everything else. Once the spending money is gone, you're not allowed to spend any more money. That's it. You got to know how to live below your means. Your investment money is the money that you're using to build your wealth faster. You can use your investment money to pay down your debt faster. You can use it to buy stocks or real estate or start your own business. The main thing with your investment money is this money needs to be used to buy assets, which are things that pay you. You do not want to use your investment money to buy liabilities, which are things that just take money away from you. And your saving money is your emergency cushion. This is the money that you can tap into if you run into a tragedy or if you lose your job. This is the cash that you have to protect you from these emergencies. But here's the catch. You don't want to just save your money just to save it forever, okay? Your savings are losing value to inflation, so you want to be thinking bigger. Once you have 6 months worth of expenses saved for an emergency, this is not money that you're saving for a down payment on a home or something else. This is just cash you're saving for an emergency. Once you have 6 months of these expenses saved, now you want to start thinking about reallocating the saving money either to your investment or maybe a little bit to your spending money too. Making a budget is the easy part. The hard part is sticking with it. Thankfully, we're in a digital age, and you can turn your good budget into a great budget by automating this whole process. If you know that $5,000 are coming into your bank account every single month, then you can create automatic transfers that move 15% of this $5,000 or $750 into your investment account, and you can move 10% of this $5,000 or $500 into your savings account automatically. Now, you're putting your money to work in the right places before you even get a chance to spend it. Now, when it comes to spending, you are forced to live below your means because you have less cash left over in your spending account. Your savings are slowly building you a cushion, that way you have something to fall back on in case an emergency happens. And for your investments, well, this is where you need to know yourself and your risk tolerance. The most risk-free way to invest your money is to pay down your debt faster, because if you're paying 6% a year in interest on your student loans and you pay off your student loans a year early, well, you just got a guaranteed 6% return on your money, because that's 6% in interest that you don't have to pay to your bank. If you want to be more of an active investor, but you don't really want to go into the details of analyzing companies and stocks, then you could look into investing in index funds. You could think of an index fund kind of like a group of stocks. When you go out and you invest in individual companies or stocks, there's a risk that the company that you invest in is gonna go bankrupt. And if that happens, your investment is gonna go to zero and your investment money is gonna be gone. But if you invest in index funds, now you're not investing in individual companies, you're investing in a fund that invests in a whole bunch of companies. Now, even if one company goes bankrupt, you're okay, because there's a lot of other companies in the fund to balance that one bad company out. So this is your lower risk way to invest your money into the stock market, because now you're not investing in an individual company, you can get exposure to the entire stock market as a whole. If you want to be even more involved with your investments, then you can look at investing into individual companies, or my favorite, investing in real estate. This takes more time and effort on your part, because if you want to invest in individual companies, you got to be doing your research to make sure this company is growing and it's a good stock. And if you want to invest in real estate successfully, you got to build a team, you got to know the location, and you got to make sure your tenants are paying rent. Being more active with your investments comes with more risk, but it also comes with more potential return. Look, investing is not a guaranteed thing, okay? You are never guaranteed to make money when you invest. You might even lose money, which is why you have to do your own due diligence, and it's why you want to never blindly listen to a random guy on YouTube. But now you're building a financially healthy lifestyle, that way you can live a wealthy life. It's not easy and it's not a quick overnight thing, but it will work if you stick with it and you work for it. If you want to get your finances in order, the first thing you need to do is not hire an expensive money coach or financial planner or financial advisor. The first thing you need to do is just track your money. Once you track your money, you want to make some adjustments to how you're spending your money. Once you make those adjustments, make sure you're implementing those adjustments, and then rinse and repeat. As you